All right, Phyllis is getting ready to get her first listing, and it's a duplex, as you read about. Did you calculate the taxes? Well, hopefully you did. If you didn't, that's okay. I'm going to go through this with you, but I'd love for you to try to do some of these. Remember, you're a new licensed real estate agent now. You could be watching this as part of a CE class, and that's fine. We need to sharpen our skills, right? We need to know how to do these types of prorations. I get it. Sometimes you say, hey, John, the title company does that. But if you're going out to list a property and your client's asking you, how much am I going to net if we close this on July 15th? You need to be able to calculate and figure up a seller net sheet and come up as close as possible for your client. So we're going to do that right now. So in this example, we need to look at several variables. I'm going to read the question to you, but I just want you to understand that this is something you will see, I see on a regular basis as a real estate professional. So let's read through the problem. In this example, Phyllis is preparing for her first listing with Judy and Tom. Judy and Tom own a duplex but have decided to get out of the rental business. Phyllis is preparing a seller net sheet for her clients. Her first order of business is to calculate the amount of taxes Judy and Tom will owe on a projected closing date for July 15th. Taxes on the duplex are $3,245 per year. If a closing were to take place on July 15th, how would the tax proration be calculated for the closing statement? Now, we have several things we're going to look at with this problem. And number one, I want us to really dive into the steps or the first steps that I normally do in this situation. So what I want us to do first is to look at what I'm going to bring this up a little bit for us here. Look at what the taxes are. They are $3,245 per year. So our first order of business, this is going to be step one, is to take $3,245 and divide this by 12 so that we can figure out what the monthly taxes are. So $3,245 divided by 12 gives us $270.42. I always like to label my math problems. So $270.42. Now, here's what I would do, just to be safe, it's double check, okay? We checked it once, let's check it again. So $3,245 divided by 12, $270.42. Now, let's take the $270.42 and divide this by 30. So when we divide this by 30, we get $9.01. Now, I know there's a few of you, and this is daily. I know there's a few of you out there who said, well, wait a minute, John. The closing is happening on the 15th, right? So right here, the closing date is July 15th. So I probably need to bring that. Projected closing date's July 15th. Some of you may have said, hey, John, all I really did was take the 270.42 and divide it by 2. And there's nothing wrong with that. 270.42 divided by 2 is 135.21. And that is 15 days of I'm going to make that a little bit better here. 21. And that is 15 days of taxes. If we took $9 and a penny times 15, I get 9.01 times 15 gives me 135.15. That's kind of interesting there, isn't it? So $9 and a penny times 15, 9.01 times 15 equals 135.15. And that's probably because of rounding up and some other ways with days. However, 270.42 divided by 2, 0.42 divided by 2 is 135.21. So there's 6 cents in there somewhere that we're off. But here's the good news on the exam. They will never have anything, they will never have two answers that close. So don't worry about that. So if you divided by 2 and you tried to go this shortcut, it's no big deal. If you take the 901 times 15, no big deal. We're within pennies. Everything's good. So the next stage of this problem, the second part, is to figure out how many months. And my mother always likes to start, and she taught this for years, to start with February. And we're going to count on our fingers, okay? So we're going to start with February, March, April, May, June, July. There are 6 months and 15 days. Now, why do we count February? Remember, taxes are paid in arrears. And so if we start with February, March, April, May, June, July, that gets us to our month we need. That's 6 months. And my mother always taught me that, and I like it because it reminds me to stop on the month of closing. And that is reflective that there will be 6 months, and then we count up the number of days during that month, which are 15 days. So when we do this, we are going to take $270.42 and multiply it times 6, which is, I'm going to come over here on the side, 1,622.52. And I'm going to put 6 because it is 6 months. It's 270.42 times 6, okay? And then we're going to bring our 135.21 over. Actually, I would have just divided by 30 and multiplied it times 15. So I'm going to use the 135.15. That's 15 days, so 6 months. And this is days. And so when we add this together, I get 1,757.67. That's the amount we're going to need to prorate, okay? Now, how does this look on the closing statement? This will be a debit to the seller. So a debit to the seller for 1,757.67, and it will be a credit to the buyer for 1,000. Let me move that over. It would look better there. 1,757. $757.67. Again, this would be the seller side, and this would be the buyer side. Now, there would be two separate closing statements, but just keep in mind it's a credit to the buyer and it's a debit to the seller, and it's the same amount. Now, let's kind of just talk this through. Why would it be a debit to the seller? Taxes are paid in arrears. In other words, December 31, or in December, when you get your tax bill, you have to pay the taxes. And you are paying for the year that you're in. Right now, while I'm recording this video, it's 2021. And my tax bill came in. I'll be making my tax payment this week. Now, I'm actually paying for 2021, not 2022. So if you sell the duplex, in this case, Tom and Judy, if they sell the duplex on July 15, they're responsible for the taxes from January 1 until July 15th because they have owned the property for 6 months and 15 days. And so we need to charge Tom and Judy and credit whoever buys it. Now, at the end of the year, the new buyers will pay the full tax bill for the whole year. And they may call you and say, wait a minute, why am I having to pay the entire year? And you're going to have to show them on the closing statement, I've done this for years and years and years, don't panic. On July 15th, the title company actually gave you a credit. And so had none of this taken place on the day of closing, you would have had to have come up with an additional $1,757.67. But instead, you got a credit for that on the closing statement, and so you didn't have to bring that extra money to the table, but you're going to have to pay it at the end of the year. So it all works out. It's all fine, but it is going to be a debit to the seller because they've owned that home from January 1 till July 15th, and we are going to credit the buyer for that amount. And then at the end of the year, the buyer will pay the entire amount. I hope that makes sense to you. We're going to work through more prorations and more problems, but just remember this, taxes are paid in arrears, and when we close on that property, they are going to charge the seller, debit the seller from January 1 until the day of closing, and then credit the buyer for that amount. Now, in some occasions, like now in December when I'm recording this, they may charge the seller from January 1 till the day of closing and go ahead and charge the buyer the 10 days of the year that are left or 9 days of the year that are left. And then they will just pay the tax bill themselves, the title company. But if it's back in October, 1st of November, anytime throughout the year other than that, they're going to debit the seller and credit the buyer.